Right on the busy Las Vegas Strip is where the core properties of this entertainment REITs are located. Some of the best known and most successful operators like Caesars Entertainment and MGM Resorts count to their tenants, and with their strategy of acquiring unique and high quality gaming, golfing and entertainment real estate, they have found a great niche to thrive in. Of course, I'm talking about VICI Properties, and at the time of this video going live, I'll actually be visiting to Las Vegas for the CES trade show. Even though their sector was hit hard by the COVID pandemic, VICI could navigate the circumstance very well and also found some new premium acquisitions and development targets in the Chelsea Piers in New York City and their new cooperation with Cabot and Bolero. But can the company also withstand the continued environment of increased interest rates and general economic headwinds, while still keeping the dividend safe or possibly even growing? In this video, we will dig into the markets of VICI, analyze the strategic position by doing a Porter's 5 Forces analysis, and have a look at the latest financial statements to see how they are doing. We'll also check the valuation and do a fair value calculation. In the end, we will see if VICI is a good long-term investment for us or not. VICI has the ticker symbol of VICI on the New York Stock Exchange. They are working in the real estate sector and were founded 2016. They have 23 employees at the moment, and their headquarters is in New York City. The market cap sits at $33 billion at the moment. VICI is a REIT, a real estate investment trust, that is focusing very much on gaming and entertainment properties. So here you can see, for example, they own 45 gaming properties, a lot of hotel rooms, but also casinos, the gaming space with the gaming units inside, convention space, but also outlets, entertainment venues and retail outlets. If you look at the history of VICI, we can see that since their foundation in 2016, basically every year they have acquired new properties in this segment with a huge focus on properties in Las Vegas, especially the Las Vegas Strip. So you can see, for example, here is Harrah's Las Vegas. We have El Dorado Resorts. We have Caesars Entertainment and Caesars Forums. We have MGM properties. This brings a very, very unique position, but also a very concentrated position on this specific market here. Of course, with Las Vegas being one of the best locations all over the world for gaming and entertainment, this concentration definitely makes sense for them. When we look over at VICI's homepage to check out their geographic diversification, we can see that all of their properties at the moment are located in the United States. They are working on diversification and also to expanding to different countries. We will see this later on in this analysis, but for the time being, they are very concentrated, especially on gaming properties within the United States. When we dive a bit deeper into the details of VICI's customers, we can see that two major customers make up the vast majority of the rent. Caesars Entertainment makes up about 40% of the rent and MGM Resorts 35%. So we have a huge concentration of only these two customers, although the number of properties they own is not so small and they are also quite large. What is very nice to see though is that 100% of these leases are triple net leases. That means that their customers actually have to take care of insurance, taxes and maintenance of the properties. So VICI doesn't have any additional costs. The vast majority, more than 95%, of these contracts are very long term and they have a built-in inflation protection. So even in case of higher interest rates, VICI has some security here so they can increase also their very long running rents. Just a couple of weeks ago in December 2023, they announced 2 new partnerships and 1 new property buy. One of the partnerships is Cabot Partnership. Here they are partnering to build up new golf courses, and not only in the US, but they are also trying to diversify away from the US. For example, Cabot Highlands is in Scotland, UK, and Cabot St. Lucia is in the island nation of St. Lucia. Another transaction they just announced also in December is the acquisition of the Chelsea Piers in New York City. And here you can see that the initial lease term is running for 32 years. So a very, very long lease term again with them. And they have a rent escalator. So again, inflation protection built in. But here again, we can see the focus of VICI on these prime entertainment, prime sports and prime gaming venues in this case here in New York City. The third acquisition they just announced, or partnership, is the partnership with Bolero. And here Vici just announced the acquisition of 38 new bowling entertainment centers all over the US. The offline entertainment and gaming sector has been hit very severely with the COVID pandemic a couple of years ago. But when we look at this market report from PwC, for example, we can see that the recovery for live entertainment is already going on. We are almost on the same level as we had 2019, and the recovery is expected to go on in the next years also. For example, they expect that the cinema box revenues will reach the pre-pandemic levels by 2025. And they expect the live experience revenue will grow at a 9.6% CAGR up until 2027. And when we look at this market report from Deloitte, we can already see that the leisure travel especially is already exceeding pre-pandemic levels in the US and also Europe. Only in Asia Pacific it is still lagging behind. However, they are also concerned about the quality equation, how they put it. That means basically that during the last years it was very easy for the hotels and for the operators to charge higher costs. And they expect that this cost premium should go down in the next couple of years. When we look at the strategic position of VG by doing the Porter's 5 Forces analysis, we can first of all see that the threat of new entrants is low in this area. For REITs in general and for entertainment and gaming REITs especially, the entry barriers are very high, there are regulatory barriers and there are very high capex barriers. So for this reason, I don't think that VG has a huge threat of new entrants here. The threat of substitutes in this sector is usually very high because the operators have a lot of different venues, a lot of properties to choose from. But in case of Vici, I think that they have a very unique position with their unique and high quality properties and their long lease terms. So in this case, I think the threat of substitute, even though it is usually high in this industry, for VG, I would estimate it as medium to low. The competitive rivalry is also very high. There are a lot of properties to choose from, and numerous different players in the gaming and entertainment sector are fighting for market shares here. Again, even though the competitive rivalry is very high, I think with the unique position that VG has, they still have an advantage here. The bargaining power of their customers I would estimate as medium. On one hand, we already saw the concentration of only 2 very big customers, which gives these 2 customers a lot of pricing power, got a lot of negotiation power. But on the other hand, we have the very long triple net leases that VG negotiates, also with a built-in rent escalator for inflation protection. So this, again, combined with the unique position of the properties that VG owns, does give them quite a good position here. The bargaining power of their suppliers, on the other hand, is very low. They are working in an area where they can choose from multiple suppliers, and the stuff they do source is mostly building materials, furniture, or some kind of equipment. They can choose from different suppliers here, and they do have definitely the pricing power with their size. So I think they have a very good position against their suppliers here. Even though VG is operating in a highly competitive market, it does seem that their position here is quite good actually compared to their competitors. And with their unique properties, they have built a moat for themselves. When we compare the performance of VG of the last years with the S&P 500, and I use the total return here again, because VG is a dividend payer, we can see that in the last year, VG did underperform the S&P 500 by quite a bit. But that is true for most other REITs also, because the rising interest rates have made it very difficult during the last year. When we look at the 5-year performance, we can see that VG actually did outperform the S&P 500 by a little bit. And to look at the 10-year performance doesn't make so much sense in this case because VG doesn't exist for 10 years yet. When we jump into the financial details of VG, we can first of all see that the operating profit and the net income has risen quite nicely over the last years, and the expectation over the next years is also that this will increase nicely again. When we look at the balance sheet, we can actually see that the leverage of VG is sitting at a 5.5 debt to EBITDA ratio right now, which for a REIT is still very reasonable. Because of the special nature of REITs, let's also have a look at the latest quarterly report, the 10Q report of VG. And here we can see that actually the total assets have increased in 2023 compared to 2022 by quite a bit. Here we have an increase of the total assets of around $5 billion US. And when we compare this to the increase in liabilities, the liabilities only increased in $3 billion US. And when we scroll down here, we can see that they could increase their total revenue and their income while even lowering their operating expenses here. Although the operating expenses either way sit on a quite low level. And when we look down here at the weighted average number of partnerships units outstanding, we can also see how they did finance their properties. When we compare this number from last September, 850 million partnership units outstanding compared to the 1 billion as of today, we can see that there was a significant increase. So they did at least finance a part of their acquisitions by issuing these new partnership units, basically by diluting their shares. Let's have a last look at the debt composition and the balance sheet of VICI. And here in their investors presentation, they state that they have a long-term net leverage target of 5 to 5.5 debt times EBITDA. And if we look at the debt composition over here, we can see that their debt is due over the next years and the split is quite evenly. So there is not one huge bunch of debt to be paid in the next years. Also, 99% of this is fixed rate debt. So with this, VICI can actually lower the risk of the rising interest rates or the fluctuating interest rates. When looking at my checklist, we can see that the revenue growth of VICI over the last 5 years has an amazing 32%, and over the last year it was even 54%, so even higher. The net income growth is the same. We have a CAGR over the last 5 years of 41% and a year-over-year value of almost 200%. So insane revenue and net income growth here. Instead of the free cash flow, for a REIT it makes more sense to look at the adjusted funds from operation, AFFO. So I use this number here, and we have a 5-year CAGR here of 39% and a year-over-year value of 6%. So this beats my threshold of 6% AFFO growth over the last 5 years easily. Green checkbox. Usually the debt to EBITDA ratio that I would like to see for my stocks is below 3 times. In case of a REIT, the valuation is a bit higher because with the properties they deal, there is a high capex necessary. One of the options for REITs to grow is taking on new debt to finance new properties for their growth over the next years. My debt to EBITDA target for REITs is actually 5 times debt to EBITDA ratio. In case of VICI, they are sitting a little bit above that with 5.5 times. So it is a yellow checkbox for me, but we also just saw that this is well within the target of VICIs themselves. So I think it is really not too worrying. They are paying a lot of dividends. The current dividend yield sits even above 5%, and they have a 5-year dividend CAGR of more than 10%. So really we have a nice dividend payer and dividend grower. Especially this high dividend yield combined with this high growth rate makes it a very attractive position for dividend investors. The margins and the return of invested capital is also increasing over the last couple of years, so they get a green checkbox here. Overall, the financial position of VICI does seem to be very good. The only grain of salt we can find here is the quite high share dilution of higher than 20% 5-year CAGR. So rather than taking on new debt, they did issue new shares instead to finance these acquisitions, or to finance a majority of these acquisitions here. And for a long-term investor, especially this very high value of share dilution is not so nice to see. Before we sum this up, let's have a look at the valuation of VICI. And again, because VICI is a REIT, it doesn't make sense to look at the PE or the price to cash flow ratio. It makes much more sense to look at the price to AFFO ratio in this case. And unfortunately, Seeking Alpha doesn't provide a nice chart here, so we have to look at the pure numbers. But what we can see here is that the price to AFFO ratio in the trailing 12 months and also forward looking sits at a multiple of 15. The sector median is around 14 or 14.9, so it is quite on the same valuation as the sector median. So here VICI looks to be in line with their sector peers. As a dividend grower, we can also use the dividend yield for the valuation of VICI. And if we look here at the history of the last 5 years, it was always fluctuating between 4 and 6-ish%. So even though the dividend just came down from around 6%, it does still sit on the higher end of the range they had over the last 5 years. And if you look at the dividend safety, how well they are covered, it makes more sense to look at the AFFO payout ratio. And here Vici sits at 75%, which is quite a good value for a REIT. We can again see here the sector median sits also at 74.5%. So Vici is very in line with the sector median here. Let's jump into my valuation spreadsheet now. And here again, because Vici is a REIT, I removed the discounted cash flow and the multiples calculation, and I'll only rely on the Gordon Growth dividend calculation model here. For this, I plugged in the current dividend of Vici, and I plugged in the dividend growth rate over the long run of expected 5%. 5% is actually quite a high dividend growth rate, especially over the long run. But we also saw that even over the last 5 years, Vici did have quite a high growth rate of even 10%. So let's just assume in this case the 5%. And with a 5% dividend growth rate, our Gordon Growth model comes to a fair value of $43.5. And by including my margin of safety of 10%, we come to a value of $39. The current stock price sits at $31.9. So it seems like the stock currently is a bit undervalued. If you think that the 5% dividend growth rate is a bit high for Vici, let's just correct this down to maybe 4%. And if we look at the Gordon Growth model now, we can see that without a margin of safety, we are sitting at $34. And by including my margin of safety, we are sitting at 31, which comes very close to the current stock price. So by keeping these numbers in mind, I do think that the valuation of Vici is very reasonable. If you did like the video so far, please consider leaving a like or subscribing to the channel. It would help me out a lot. Also, if you have any comments about my analysis or about Vici itself, please leave them down in the comment section. I would be very interested about your opinion. With their unique and high-class properties, Vici could carve out a nice niche position for itself since their inception in 2016. During this short time, they did even manage to be included in the S&P 500 index. And even though the greater entertainment sector was hit hard during the COVID pandemic, Vici did manage this black swan event remarkably well, and today they are in an even better position than before. Vici did mostly focus on prestigious gaming properties in the US, especially Las Vegas, but today they are also looking to diversify their portfolio by looking at golf properties in Canada, UK and St. Lucia. Not only that, but they could manage this remarkable growth without overloading their balance sheet with debt and are sitting at for a REIT, relatively low leverage value of 5.5 debt to EBITDA ratio. In order to do this, they did need to issue new shares and have diluted their investors quite significantly over the last years. Most likely, they will have to face a tougher environment in the investment and real estate market over the next years with higher interest rates and the current economic instabilities. The gaming and entertainment market is also one of the more economically sensitive markets out there because of the non-necessary nature of it. So, even though Vici is not without risks, I do like the moat they built with their unique market position and their high-value properties. I also like their growth strategy with partnering with golf courses and their effort for more diversification. The valuation of Vici just sits a tiny bit above the sector median, but compared to its fair value, the stock price does seem to be very reasonable right now. So I think Vici is an excellent investment for a long-term investor, and as full disclosure, I am also invested myself. In fact, I just purchased more Vici shares back in November last year. So thank you very much for watching, guys, and see you next week.